In business, a monopoly is like a license to print money. In fact, a monopoly gives a business such an advantage the government has made it illegal. But one company has just recently created its own monopoly, and it could mean big money for investors. When John D. Rockefeller built up Standard Oil to control 90% of the oil industry, creating a giant monopoly, the government passed the Sherman Antitrust Act in 1890 to bring down that kind of power that comes from monopoly control. And for the last 100 years, the antitrust laws have been applied to every industry, from oil to sugar, tobacco, and steel. The government fears the power of a monopoly so much that it's one of the few regulatory laws with criminal prosecution, a fine up to $100 million, and 10 years in prison. In just over 10 years to 2009, nearly 250 individuals and 143 organizations were convicted under the antitrust laws. The individuals alone were sentenced to more than 62 years in prison and up to $7.5 million in fines. The Biden administration has launched a revolution in antitrust cases, bringing complaints and blocking dozens of deals in the first year alone. Just this year, NVIDIA was set to extend its domination in semiconductors by acquiring process innovator ARM, until the government shut down the talks. But when the government loses these cases, investors stand to win big time. And this video is the story of the government's most recent loss, the monopoly it creates, and the upside investors for one company. First though, if you want to stay on top of news like this, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign-up link below. United Health Group, ticker UNH, is already the largest health insurer in the United States, with medical benefits that cover 50 million members globally. It's also a leader in pharmacy benefits and health analytics. The company counts a market share of 15% in the U.S. health insurance market by premiums, more than any other competitor by a wide margin. It also fills 1.4 billion of the 6 billion prescriptions in the US annually. That's almost 1 in every 4 prescriptions in the country. Now, that kind of vertical integration of the healthcare industry, from insurance to pharmacy benefits to services, gives United Health a unique advantage and the ability to control healthcare costs in its system. It helped boost the company's profitability and has helped drive a 21% annual return for shareholders over the last 5 years. And beyond all this, United Health just got what could be considered inside information into its competitors in a deal to acquire Change Healthcare. Now, Change provides financial and administrative services to health insurers, giving it an inside and intimate look into each of these companies' reimbursement policies. Change knows every detail into United Health's competitors, from billing to patient care. You get a sense of the scale of this from its website. The company helps health insurers with payment accuracy, medical records, and ultimately with their payment decisions. It has intimate detail into providers, hospital services, about their revenue, payment information, and networks. It's a big reason why the American Hospital Association was one of the first to protest the United Health acquisition, fearing all that information would then go to the insurer. It also provides pharmacy solutions and holds data around that. In fact, through its services, Change manages a third of the healthcare claims in the United States across 2,000 government and commercial payers. It has access to 1 in 5 of all patient records and data on over 5,000 hospital business decisions. Basically, every customer and competitor of United Health. Change is now going to be bringing that data to the company. Now, the Biden administration sued to block the deal in February. The Justice Department's argument was that the deal was going to give United Health a monopoly through its access to that Change Healthcare data clearinghouse, which rival insurers use to compete. The American Hospital Association was also heavily involved fighting this acquisition. The government and all these other industry players believed the deal would give United Health an unfair advantage, not just over health insurance competitors, but also in negotiating with health providers and drug makers, and now they're going to get a chance to see if they were right. That's because last month, a federal judge ruled against the government's case, saying the acquisition could proceed. United Health is being required to sell off its claims processing segment, so the combination doesn't create too much unfair advantage, but there is still a lot to like for investors. Now, United Health will have access to data its competitors use to make business decisions, basically giving it an inside view on how Humana, Anthem, and Cigna run their companies. Now, what does this mean for investors? United Health has already grown sales by an 8.2% pace over the past 3 years, but This deal is expected to increase that to 10% or more through 2025 to more than $424 billion. Now, while the company's sales growth is under competitors like Centene, UnitedHealth has the strongest profitability in the group with an operating margin of 7.6%, and it's likely this deal makes it even more profitable. That 10% sales growth may not seem like much, especially when you consider growth of 20 or 30% in some of those tech stocks that we talk about on the channel, but consider this. It's nearly twice the rate of the overall health insurance market is expected to grow. Now think about what that means. If UnitedHealth's main market is only expected to grow by about 5.5% a year, but the company is expected to post 10% sales growth, that means it's likely taking that market share away from its competitors. Not only does that mean higher earnings, but it can also use that market dominance to increase profitability. In fact, I don't think the investors or the market really understands yet how beneficial this deal will be to UnitedHealth's profitability or its ability to take business from other insurers. United will know its competitors' business policies, potentially being able to undercut them in insurance and other services. It's going to be able to use that scale and this competitive advantage to squeeze others out. The acquisition is expected to boost earnings by 50 cents a share immediately, and the company is expected to post 14% earnings growth annually to $32.75 per share in 2025. Now, UnitedHealth already spends $5 billion a year repurchasing its own stock and $5.2 billion in dividend payments to investors. And I know a 1.3% dividend yield isn't that great, but UNH has increased its dividend payout by 17% a year over the last 5. That's from just 75 cents to $1.65 a share. And that's also on top of the share price appreciation, producing a 21% annual return over the last 5 years. That's a 163% return and more than 2.5 times the return on the overall stock market. And I know a lot of you growth investors out there are saying, an insurance company, that's never going to make me rich. Any industry expecting just 5% market growth, even if the company is expected to double that, yeah, it's not a stock that's going to shoot the moon higher. And you're right, but it's also not a stock that's going to lose your money. Everyone needs health insurance, and the company's cash flows are extremely stable, no matter what the economy does. Here's a graph of UnitedHealth after the tech bubble burst in 2000, beating the stocks in the S&P 500 by 195% over the next 2 years. And here's what the stock has done just over the last year, protecting your money from a loss in stocks and actually producing a 29% return. Now, the shares did get hit during the crash of 2008, just because of what that crash did to all finance and insurance companies, but has produced a 29% annual return over the last 23 years since that bottom. Now, on valuation, the company posted $20 a share earnings over the last year, which puts it at a price to earnings of about 25 times. And that's slightly above the 22 times price to earnings average over the last 5 years, according to Morningstar. And that's about the same valuation as shares of Centene, but is over the 20 times PE ratio on Humana. So shares aren't cheap here, but not necessarily expensive either. We see that the PE ratio was as high as 31 times at the peak in 2021, but I don't expect it to get back to that point anytime soon, especially not with stocks struggling. Now, even if that PE ratio is topped out, just the earnings growth alone plus the dividend could make it a 15% return per year, and that growth may still underestimate the benefits of this acquisition. Analysts have an average target of $593 a share over the next year. That's a 15% return, and the top target is as high as $650 each. On that forecast for $32.75 in per share earnings through 2025 and no change in the price to earnings ratio, the shares are worth $818 each over the next 3 years. That is a 61% total return, plus the dividend yield, which, again, that dividend payment has increased at a 17% rate over the last 5 years, so you're going to be collecting a higher yield on your investment. In today's market and stock uncertainty, that monopoly power is going to be worth a lot. Click on the video to the right for the 5 dividend stocks that beat the QYLD, 5 stocks for monthly cash flow and returns. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.